From Bloomberg World Headquarters in New York to our television and radio audiences worldwide, welcome to Balance of Power, where the world of politics meets the world of business. I'm David Weston. Another day with GameStop and Reddit and short sellers at the top of the news agenda, even as the market overall rebounds from a down day yesterday. For the latest, we welcome now Romaine Bostwick. He is the co-anchor of What Did You Miss? So, Romaine, thanks for being back with us here today. Give us a sense of what's going on with GameStop. First of all, I looked at it earlier on. It was down, it was up, and now it's down.
Yeah, I mean, at one point in pre-market trading, it was above 500. It opened lower by about 30%, and then kind of bounced around all day long here. There were several volatility trading halts, not only on GameStop, but a lot of the other sort of meme stocks out there, AMC, BlackBerry, American Airlines, quite interesting getting caught up in this as well. But what's interesting here now is this is becoming a much bigger story than just the price action here right now, David. You're talking about companies, the brokerages primarily, Robinhood, Interactive Brokers, Schwab, TD Ameritrade, basically saying that they're putting curbs on your ability to trade these stocks, including AMC and GME. Robinhood actually saying that. Interactive Brokers took it a step further, saying not only can you not trade some of these stocks, but there's going to be higher margin limits. And what's interesting is they're basically liquidating the options on specific stocks, basically shutting down the market in some of these things, really raising a debate right now as to not only whether what they're doing should be done, but really kind of the ethics of it. There's really this idea here that the markets have already really, for the most part, been seen as a casino. It's just basically been a casino for the big guys, and now the little guys are here taking over the casino, and there's a broader debate as to whether you should be shutting them down if you allow the big folks to do it. You're seeing on our board here, for our viewers here on TV, all of the people who had piled into puts, but we also saw a wide variety of just volume across the tape here, whether it was the small cap stocks that were getting bid up, but even some of the larger cap stocks that were actually getting bid down. That created one of the most volatile days that we've seen on Wall Street on record, pretty much across the tape here. 23 billion shares swapped hands yesterday. Right now, as of the time of the year show started, we already had about 10 billion shares swap hands. So it looks like we're going to finish the day probably not at a record, but well above the averages that we would normally have here. The other thing, too, that I want to point out, too, is that when we talk about this debate here as to whether or not some of this trading activity should be shut down or should be curbed, we should talk about this idea here. The idea here that there are a lot of people right now that are getting shaken out of these trades right now, David. A lot of people are getting hurt. And the question now is, do you go to protect those people just because they're smaller traders, or do you just sort of let the chips fall where they may?
It sure is a wild story. Yeah. Thank you so much for being on it. That's Bloomberg's Romaine Bostwick. And I want you to be sure to tune in for his interview later today with Interactive Brokers Chairman and founder Thomas Peterffy. That is at 3:30 p.m. Eastern Time on The Close. Given the market disruption that has come in the wake of the GameStop phenomenon, questions necessarily arise about possible regulation. Welcome now a member of the House Financial Services Committee. He is Republican Congressman Andy Barr of Kentucky. Mr. Congressman, thank you so much for being with us. We have now one of your colleagues, Alexandria Ocasio-Cortez, calling for a hearing from Financial Services, and actually Senator Cruz, who normally doesn't align with AOC, saying she thinks that's a good idea. Do you need hearings?
David, good to be with you. I don't have a problem with hearings to look into this, and I certainly think it's appropriate for the SEC to continue to monitor whether or not any activity on these message boards like Reddit, Wall Street Bets, whether any of that actually violates existing laws prohibiting market manipulation. But from everything I've seen so far, I don't see anything illegal, and I don't even see anything that's potentially systemically risky here. You know, there's nothing illegal about sharing your stock ideas on social media or a message board. Obviously, many of these hedge funds have taken a big loss because of the advent in this COVID era of day trading and zero-cost trading by retail investors. I think that will impose some market discipline on the part of these sophisticated Wall Street professionals. Obviously, we are looking at the issue of retail investors potentially taking heavy losses in a late rally, call option buy. We're looking at that. I think we should look at that. But at this point, I think on both sides of the equation, these developments will create some market discipline, and hopefully for the retail investors who do lose out on the back end of this rally, and what we see is a big loss in GameStop today, it looks like. I think what that will do is refocus retail investors and day traders to earnings, valuation, and fundamentals.
What about the level of short interest? At one point, there was more short interest than there were shares in GameStop. It might make sense to have some curbs at least to limit how much shorting you can really do in a given stock.
Well, I think we need to look at the laws related to naked shorting and make sure that naked shorting is, number one, prohibited and that those laws are being enforced correctly. I think that makes sense. But there's nothing inherently wrong with shorting. And so what we don't want to do, David, is overreact, act too quickly in a way that would impede liquidity in the markets or natural shorting or hedging. And also, on the other hand, for retail investors, we don't want to stop this, I think, very positive and favorable trend of democratizing access to the capital markets. Day trading and zero-cost trading is actually, I think, overall a very good thing.
Well, what you raise here is impeding democratization of the markets, as you put it. That, I think, is what AOC specifically was talking about. It was the Robinhood decision to really curtail trading, saying, why are you keeping the little guys, if I can call them that, out of the marketplace? It sounds like you might be sympathetic to the notion maybe there's some restrictions on people like Robinhood.
Yeah, I know, and maybe the lack of regulatory intervention here has caused the market and some of these day trading platforms to intervene themselves. But again, I don't want to see anything that would impede, market access for those retail investors. And again, I don't see anything illegal here yet. And so I think the market is actually working to impose discipline. I think the hedge funds are learning a lot. And I think on the down.
Congressman, can you hear me? It appears we may have lost Congressman Andy Barr, Republican of Kentucky. I apologize to the congressman for that. It was a fascinating discussion about whether there should be regulation or not. He says there should be a hearing, but he doesn't want us to overreact, as he put it. In the meantime, let's go to Bloomberg First Word News. For that, we go to Mark Crumpton.
David, thank you very much. President Biden will make it easier for Americans to buy health insurance during the pandemic. He's reopening the federal Obamacare marketplace with an executive order today. A 3-month special enrollment period will begin February 15th. That will offer a path to health care for people who lost their insurance when they lost their jobs. The European Union and AstraZeneca are locked in a dispute over coronavirus vaccines. The drug maker refuses demands that it take vaccine supplies from its British factories to increase doses going to the European Union. The root of the issue is AstraZeneca's decision to give the UK priority over the EU following a production glitch in Belgium. Hotels, airports, and airlines across Mexico and the Caribbean are rushing to set up COVID-19 testing sites to meet new U.S. entry rules and salvage demand for the pandemic-hit travel industry. In Mexico, popular tourist areas like Cancun have set up multiple testing sites inside airports to accommodate travelers to the United States. Hyatt Hotels is offering complimentary testing at its 19 Latin America resorts. Marriott is providing a mix of on-site testing and help coordinating with local facilities. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thank you so much, Mark. Coming up, economic numbers out today appear to support Fed Chair Powell's recent reaction to the economy. We talk with Julia Coronado of MacroPolicy Perspectives. This is Balance of Power on Bloomberg Television and Radio.
The economy is a long way from our employment and inflation goals, and it is likely to take some time for substantial further progress to be achieved. Overall, our interest rate and balance sheet tools are providing powerful support to the economy and will continue to do so.
That was Federal Reserve Chair Jay Powell yesterday at his news conference following the FOMC decision. We welcome now Bloomberg International Economics Policy Correspondent Michael Mckee. So, Mike, thanks very much for being with us. Give us an interpretation, put together, if you can, what Jay Powell was talking about yesterday with what we saw, for example, out of the GDP numbers today.
Well, David, the Fed's in a tough spot right now because the economy is rather slow, rather weak, and yet they're being blamed for putting a lot of liquidity in the markets that's causing things like GameStop. Take a look at what we got in today's data dump. You look at the jobless claims numbers, 847,000, and at this point, that is 67,000 lower than last week, which sounds great, except you can see how for years we were just way down here below 200,000, and now we're way up here and just not moving. We've flattened out. GDP came out today for the fourth quarter. It was expected to be, well, in the market's parlance, bad. It was 4%. Now, before 2020, we would have called that great. But in context, it's really not that good. The forecast was for 4.2%. And of course, in the third quarter, it was 33.4% because we were seeing a big rebound in terms of the GDP numbers. So that is a problem. It definitely slowed down. And you could see that mostly in the consumer spending numbers. Consumer spending just up 2.5% in that quarter, and in the quarter when people are supposed to spend a lot of money on things because it's the holiday season. And here's the other problem that Jay Powell is really worried about is this is the total number of dollars in consumer spending. And you can see it remains well below the peak back at the early part of last year. And until that gets filled in, we won't be in official recovery. We're just rebounding. And a lot of that isn't going to get filled in because a lot of that is spending on services that won't be recouped. Yes, you might buy a new refrigerator if you keep your job. And yes, you might buy a new car, but you're not going to get a haircut that you skipped back in October again. Those sorts of things are gone forever. So the economy's got a ways to go before it can recover. This chart coming up a little late, but this is one I was talking about. You can see GDP, how it rose. I mean, it fell so much during the second quarter, then it rose a lot in the third quarter and then way back down here in the fourth quarter. So we're still not getting the kind of growth that we need to get back to where we were, and that's where the Fed's goal is.
There you go. Okay, thank you so much to Bloomberg's Michael Mckee. We're going to welcome now Julia Coronado, and where she can give us a sense of really where the economy is today. She is a former Fed economist as well as founder of MacroPolicy Perspectives. So, Julia, thank you so much for being with us. Let's pick up on where Mike was right there. The economy has come back some. It appears that the curve is flattening out a bit. But give us a sense about the gap between where we were and where we are now.
Yeah, no, I mean, I think Michael did a great job of laying that out. I mean, we are far from where we were pre-COVID, both in terms of consumer spending and more importantly, in terms of jobs. And so the slowing in the jobs recovery, the level of jobless claims, which is still just mind-bogglingly high, says we're a long way from where we want to be. And then when we're losing momentum, and it's all tied to the pandemic. So we need to stay focused, and the Biden administration seems very focused on vaccines and distribution and take up. And because we just simply can't get there until we solve this problem and manage it.
Julia, take me through one thing that you've pointed out, and that's the difference between services and goods. I mean, oftentimes in a recession when you come back out, it's services really that bring you back out. Right now, services are lagging behind because, as Mike said, we can't go out to restaurants, we can't go to movie theaters, we can't make use of those services. Is that good news or bad news? I mean, I guess I'm saying, is there structural damage where the restaurant may not be there? Or is it good news in that, boy, once we do get the vaccine, we can all come back out again?
I mean, I think it's a little bit of both. And the worry is that the longer this drags on, the more those permanent scars are likely to be there. So as a restaurant is a perfect example. How long can they hold on? Is the fiscal support enough? And then not just the fiscal support, but even when we can reopen, how quickly are firms that say occupied office space in center cities, are they going to come rushing back? Are they going to bring all their people back? Is it going to be the same demand structure to support the restaurants in those areas? Or are we going to have to restructure the geographic distribution of small businesses and other activity that supports people that are working if we end up with more work from home? So there's a lot of unanswered questions. And again, the longer we stay hunkered down and dealing with the pandemic, the more lasting the scars and the bigger the frictions are in the recovery. There's always frictions and restructuring in a recovery, right? There's always winners and losers and businesses that have to restructure business models. And that is one of the things that slows down the labor market recovery. There's no reason to think that this is going to be any different. Yes, it was an external shock. It's nobody's fault, but it's a real shock, and it's going to change the way we do things. Some of which will be for the better over the medium term horizon, like telehealth and some work from home, but it requires an adjustment and a restructuring. And some businesses won't make it, and others will have to start up. They're going to need capital to do so and clarity in the outlook to do so. So it's not just a matter of flipping a switch.
So we all agree that we need the vaccine, that's ultimately the answer to the problems we have. But there's a limit to what most of us can do about affecting that. There seems to be a consensus maybe by the summer, maybe July, August time. If you take that as a given, what else can be done? Do we have a mismatch here? Going back to Jay Powell yesterday, they certainly have very loose monetary policy. At the same time, there's concerns, as you know, about bubbles and asset bubbles and things. Is that really helping the problem any at all?
Is what helping the problem? The monetary policy?
Yes, extremely loose monetary policy.
For sure. I mean, look, it's asymmetric. Okay, so what the Fed's aggressive actions did in the crisis phase was short circuit a real crisis from becoming a financial crisis. Undoubtedly, that cuts off the tail of how bad it could have been, because businesses don't have to hunker down even more or pull back even more because they don't have access to capital or because their share price is being pummeled. So, and consumers can feel like at least their savings are okay. So there's a lot of benefit from stabilizing and providing that liquidity. Now, some of the things that we're seeing in terms of market structure and volatility, I don't think we can draw a line directly. I mean, the liquidity that the Fed provides is one of the factors that is a necessary condition for that kind of speculative volatility to emerge. But there are other things that are driving a lot of this. I mean, we have a lot of fiscal policy. And so one unintended consequence of making sure that the economy has lots of liquidity and consumers have lots of liquidity is that some of that spills into markets. Is that a reason not to do it? Absolutely not, because we're also getting money into people's pockets that can pay the rent and feed their families and keep their businesses afloat. So that's not a reason not to provide that support. And then, of course, there's the fundamental optimism tied to the vaccines and the possibility that we can reopen more quickly than in prior recessions. And so that leads to some speculation. And then there's this added factor, I think, in the whole issue that we're seeing in the last few weeks of the disruption of technology. Right? Technology disrupts every industry. It goes industry by industry, and it's an ongoing process. It's disrupting the market. It's democratizing the access to these market structures. And that's going to come with some adjustment. Both, regulatory bodies might want to sort of look at things and make sure the proper rules and guardrails are in place. Other market players are going to reprice things like option contracts. And hedge funds are going to learn that, actually these retail investors aren't something to look down your nose and chuckle about and need to be taken seriously. So I think everybody learns and evolves. I think the Congressman was saying exactly that point. So look at it, sort of think about what needs to be done. But this is just the process, the world we live in, where technology is providing access to all kinds of things that were more restricted in the past.
As a practical matter, does it make it worse if an outfit actually curtails the trading in stock, really shuts down the market in part? Because that's what we're seeing today, right, with Robinhood?
I mean, that seems like a pretty heavy-handed response, and I don't even know, I don't know. That's not the answer. At the end of the day, trading and access to trading should be available. Again, people involved in the market players, who they are changes, how these dynamics work changes, and people have to learn and adapt to that. So again, I think probably a review of the securities rules and so on is worthwhile. But shutting down trading, I don't know. I tend to be a market person. I don't think that feels like not the right answer
Well,
on a sort of structural basis.
the good news is the one thing I can guarantee you is there's going to be a review. I promise you that at different levels.
We're already seeing it. Both sides.
That's
both
coming.
Political parties are united on this.
Exactly right. Ted Cruz and AOC together again. Okay. Thank you so much to Julia Coronado. She's MacroPolicy Perspectives founder and president. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. European COVID vaccine maker AstraZeneca ending a second day in the red as he gets caught up in a very, very public row with the European Union. Emma Chandra is here to take us through the story. This is high drama over COVID.
It really is high drama, David, and a very, very public row between AstraZeneca, the maker of a COVID vaccine, and the European Union. It really goes back to the end of last week when AstraZeneca told the EU that it wouldn't be able to deliver as many COVID vaccines in the first quarter of the year as perhaps they'd initially said they would be able to. Now, this incensed the European Union, the leaders there under intense political pressure because of the slow rollout of their vaccination program in Europe. They started asking questions about why this might be. They wanted to inspect manufacturing sites within Europe because AstraZeneca had said this was all down to production issues. We even saw ministers through Europe suggesting that perhaps vaccines made in Europe should not be allowed to leave Europe, and we saw allegations of vaccine nationalism there as well. We've had calls that were on and then were back on between the two sides, and all of it being played out very publicly, including the CEO of AstraZeneca briefing European newspapers. Today, we've heard from them again that AstraZeneca is aiming to up the number of vaccines it will deliver to the European Union in the first quarter, and that crucial contract between the two of them looks set to be released, David.
So I have to say, just reading about it over here in New York, it did occur to me there was a little divorce that happened recently between the United Kingdom and the EU. Are there any overtones here of some of the leftovers of that divorce?
You could say there are some overtones, certainly because in the UK the vaccine rollout is going well and they've secured their AstraZeneca vaccine supply. The European Union leaders saying it has nothing to do with what's going with Brexit. UK leaders, the Prime Minister saying we might like to help our European friends, but we're very confident of our contract. So there's certainly been some discussion based on whether or not there is some Brexit politics to play here. One thing I should mention as well, David, though, of course, is that the European Union has not even approved the AstraZeneca vaccine. They're due to do that tomorrow.
Okay, thank you so much to Emma Chandra for that report on AstraZeneca. Coming up, today is Healthcare Day at the White House, and we get a report of what to expect from President Biden at his daily signing of executive orders. That's coming up next, right here on Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. An hour from right about now, President Biden is expected to sign a new set of executive orders. This set directed at our healthcare system. For a preview, welcome now Bloomberg Washington reporter Emily Wilkins. So we get used to this now about every day about this time. Yesterday it was climate, today it's healthcare. What are we expecting him to sign today?
Well, Biden's continuing to try and send a really strong message in his first couple days in the White House that he's trying to get things done. Two major things today in the group of executive orders and actions that Biden will sign. Number one, reopening up the insurance marketplace through the Affordable Care Act, allowing Americans who currently don't have insurance, either because they lost a job or for other reasons, to go ahead and to sign up for insurance through that marketplace. The other one today has to do with funding related to nonprofits that either provide abortions or abortion counseling. It's the nickname's the Mexico City policy, and basically it's always been something that's been hotly contested between Democrats and Republicans. You saw Obama allow for this international funding to nonprofit organizations that provide abortions and abortion consultations. You saw Trump revoke it, and now today you're seeing Biden sort of reinstate that yet again.
A fair amount of what we've seen so far, Emily, has been the Biden administration reversing what the Trump administration did. How much of that is in the orders today? Is this something, is reversing a Trump decision?
It definitely is, as far as the abortion-focused executive action goes for. And to be honest, the other order as opening up the marketplace, that was something that Democrats and others were calling on the Trump administration to do when the COVID-19 pandemic started getting bad, saying, hey, this is really a time where more people might realize that they want to make sure that they have insurance. We should go ahead and open up the marketplace. But because the Affordable Care Act is something not favorably looked upon by Republicans, Trump had declined to do so.
So, Emily, these are going to be important to the people directly involved. At the same time, in the campaign, the issue was all about public option. That's something that now President Biden really said he was going to get done. That requires work up on Capitol Hill, your usual bailiwick. Is there any realistic prospect that he's going to get that through?
I think right now we're going to have to see exactly what happens with the other top priorities. I mean, right now, everything is sort of focused on COVID-19. It's focused on the cabinet. It's focused on impeachment. I mean, certainly there is momentum within Congress to do something to either create a public option or to make other tweaks to the Affordable Care Act to try and just make it a more smoother running program. But exactly how that will be done and how can that be done, I think is going to depend on what we're going to see in the next weeks. Are Democrats and Republicans going to be able to work together on COVID-19, an area that there's a lot of overlapping agreement? I mean, if we can't get that, it might be much more difficult to move something like healthcare, where there's more partisanship in how both parties see the law.
Give us just a few seconds on that very subject. We heard Chuck Schumer, now the majority leader in the Senate, said he wants to introduce a COVID relief bill in the Senate next week. Is there any prospect of getting something done before the impeachment hearings begin?
It's going to be really difficult. I mean, we still don't have Republican senators who are firmly on board with the plan. We haven't seen any outline of exactly what this plan would look like, whether it would be something skinnier that can get Republicans on board, or whether they're just going to try and pass as much as they can and use a process that only requires Democrats to vote for it. But we are seeing the Senate begin to move on it. We also heard today Speaker Nancy Pelosi in the House say that the House will also begin to move next week on it's basically the foundation for a Democrat-only COVID-19 bill to pass. But as I said,
that takes some time, though. That takes some time, though, right? They have to have a budget resolution to do that.
Absolutely. I mean, this isn't something that's going to happen instantaneously. This can take weeks, months even. It's going to be difficult to move it in a short timeline, particularly with impeachment coming up. I mean, remember from last year, impeachment trial requires that all 100 senators need to sit at their desks. That usually doesn't happen for 6 days a week.
And be quiet and listen. That's a terrible thing for a senator. Thank you so much. Thank you so much to Bloomberg Government's Emily Wilkins. Coming up, part of my conversation with Bank of America CEO Brian Moynihan. He talks ESG investing and whether he's worried about inflation. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and radio. I'm David Weston. ESG, environmental, social, and governance, is a hot topic among investors, and that's where we started our conversation with Bank of America Chairman and CEO Brian Moynihan yesterday.
I've had the honor of being the International Business Council Chair under the World Economic Forum now last year, and I am again this year. And this group of CEOs is 100-some CEOs and senior business executives. They have been after for the last 4 or 5 years trying to figure out how we define long-term views of shareholder value versus short-term views, how we think about implementing the Sustainable Development Goals of the UN, how we think about taming capitalism or defining capitalism as what it is the solutions to these things, not the problem. And all that was sort of swimming in our minds. And then you had the rush of a lot of ratings on TCFD and SASB and GRI and all this stuff. And so we all sat back and said, you know what, if we really going to manage to deliver stakeholder capitalism, which is what the World Economic Forum and Klaus Schwab have been after for 50 years, if we are going to run our companies that way, we have to hold ourselves accountable to deliver the SDGs. We have to then have a way to measure, and it has to be consistent across all these companies. So we spent a year or so with the big 4 accounting firms developing the metrics, looking everything out there, working with all those groups to help converge metrics, got them done. Then, push came to shove, are people going to sign on and disclose them? And 62 companies have signed on so far, out of maybe the 100 that are in the IBC that could sign on in basically 90 days, and we expect more to sign on. But the key then is to democratize these out through society, not as the only metrics, but as the metrics which are straightforward, understood at a level of materiality people can get out and do them. But they'll answer the question: how are we doing on our Scope 1, Scope 2 emissions? How are we doing on our diversity? How are we doing on our governance? And it will be year after year, you'll see the disclosure so you can say they're making progress. And so that makes it a valuable system for investors and consumers and employees and shareholders.
Well, talk about investors particularly, because these sound very good, laudatory. It's good to have standards, but you want it to be actionable. Do you expect this will actually drive investment? That is to say, people will invest in one company rather than another because of their performance on these standards.
Well, so we actually play in both worlds of Bank of America, because we have a $3 trillion wealth management business, and then we have a huge capital markets business, and Candace Browning Platt and the research team, which are the best in the world, delivering it. And their research shows, which fuels into our wealth management business, and they've been at it for a number of years now, shows that if you avoid companies who are not good at ESG scores, that you will avoid 90% of bankruptcies, 95% of bankruptcies, whatever the statistics for the relevant jurisdiction. So Savita and the team that have been working on this have been delivering this. Meanwhile, other research platforms are delivering that companies with good ESG marks outperform. And so, yes, it's relevant to investors now because A, they want to analyze companies this way, and B, you're seeing performance or loss avoidance play out. Yet they needed a consistent measure. And frankly, for companies, for the hugest firms in the world, they have big staffs that can do this. But to get to a $2 billion endowment at a college or something like that, they don't have the wherewithal. So this set of metrics can give them a way to measure people that they can look across 50 companies and say, I can see it across all these different companies, even if they're not in the same industry.
Brian, as you look at the overall marketplace with respect to ESG in particular, are you concerned at all that there may be some overinvestment going on, that there may be some froth in the market? Because there are reports now about some renewable energy companies, for example, that are not really making money and that are trading at many, many multiples because there's such a rush into ESG. Is that a concern for you?
Well, and that part is a problem, because what you want to do is get the big operating companies out to solve these problems and rewarded or invested with to stay and drive them. So, we believe that there has to be a transition in the way we consume fossil fuels in this world. And by the way, the world believes that, and that's what they agreed to in Paris, and the Biden administration is going back into as we speak. The question now is, how do you make that happen? By helping companies make that transition. Us as an operator, we as a lender, and an oil and gas company that's our client. And so we need to make that transition happen, but we need to have metrics to measure that transition and hold companies accountable to make that transition. What you're seeing now is, because the idea is not across all market caps and all things, is people are channeling their money because they want to say they're doing the right thing as investors, and that might end up with companies being overinvested in. I don't look at the individual companies, so I'm not going to reflect on it, but you could see where there's a lot of capital being formed that is chasing what isn't identified. If we identify all companies, how they do on this, then the capital can be aligned against them. And then you get an alignment of the capital because the companies are doing the right things. So simply put, if all companies commit to be net zero, you have a huge transformation in what happens to energy consumption and how people can consume. So what does that mean, like a company like Bank of America? It means we created a solar, we asked Duke Power to create a huge solar installation to help us get cleaner on our energy, because without that, we couldn't do that. It creates offsets, and we go out and invest in projects. And so the investors can then follow, Bank of America is a good ESG company, a good environmental company, as opposed to channeling into something else. But right now, they don't have the yardsticks. That's why these metrics are important.
When we talk about a lot of capital looking for a limited number of investments, it's not limited to ESG, goodness knows. We're seeing a lot of situations that some people think might be a bubble or at least froth or something. Are you concerned that, in fact, because of the liquidity that's been injected for good and sufficient reason to help the economy, that we really are risking ourselves in some places? I'll give you two examples. Bitcoin, goodness knows, has gone all over the place. And another GameStop right now that is really quite a phenomenon. And it's not the only one right now that's really getting bid way up. Should we be concerned that maybe this is an indication that maybe we're getting a little bit out over our skis?
Yeah, those issues at the moment happen at time, in the ebbs and flows in the market, and then frankly, I don't have great insight as to those things. We've been clear about how we stand on Bitcoin and versus blockchain, which is a technology and stuff. But let me back up. And the question is, when you look at the economy, and it's about as big as it was in 2018, the projections from our team are for it to grow up 5% this year in 21. In 2018, in the second quarter, the economy was this big. It was projected to grow at like 1.5 to 2%. And the interest rate environment was 100 to 150 basis points higher. And there wasn't all this, so there wasn't interest rate accommodation, and there wasn't fiscal stimulus out there. Now you have the same thing. So the fiscal stimulus is needed to help people make it across the river here. You have 6% plus unemployment. You have these companies that haven't opened. That's the PPP program. You have holes in state budgets and that were created by the cost of paying for all this work, and maybe tax loss revenues and stuff. Those ought to be dealt with. And I think if we deal with that responsibly, then what happens? But the possibility of overshooting here is real, and that's what you're hearing. Less about the equity trading values at the moment, but more about the question, when rates are at 1% and are going to stay there for a long time, it'll lead to risk, and that could lead to bubbles. But the real question that will be fundamentally bad for everybody is if we miss the inflation turn, and it's not there now. But that's one of the challenges that Chair Powell and his colleagues have is to really be watching this thing, and they need to make sure this great economy grows again at the right rate and above that right rate. And there's some inflation in order to make sure it doesn't go backwards. But on the other hand, it's going to be an interesting, as we move through the end of this year and the next year, when this has all come true, the vaccine's out and stuff, it'll be interesting to see how they play through that.
Well, exactly. Let's pursue that just for a moment, because there's been a lot of money given to a lot of people, again, for good and sufficient reason. They've needed it. But the indications are a lot of it's getting saved. It's not getting spent, in part because they don't have a place to spend it, frankly, because a lot of the economy shut down. How concerned are you as you look at the economy, because you have a real vantage point into the economy broadly? How concerned are you that there might be a snapback that might actually trigger, believe it or not, inflation? We haven't talked about it in a long time.
Well, there's been, it's kind of interesting. If you trace last year, and we'll see what the fourth quarter all ends up final. But if you think about down 30, up 30, and up a few percentage, 3 or 4 percentage points or whatever it turns out to be. And then this quarter, the projections are it may come down closer to flat, and that has a little bit to do with the first quarter. But if you actually then pull that apart and look at our consumer, what we call consumer spending, and so debit and credit card spending is one thing, but this is around, people taking money out of ATMs and spending it, writing checks for services, P2P, the Zelle product, which is huge right now. If you look at that spending through the first 23 days of January, it's up 8 or 9% over last year's first 23 days of January, which was up 9% over the year before. So it is bigger in dollar amount. It is growing faster than it grew from 18 to 19, and as fast as 19 to 20. And you start to think about that, you say, that's a lot of work. Now, what's doing that? The payments came into people's accounts for the last $600, and only about 30% have gone out the back door. If you look at the type of customer, obviously for the people who are unemployed and you can see them receiving unemployment benefits, they're using the money faster. If you look at the rest of the customers, they're using discretionary retail, not sustenance retailing, not, so they're paying for their food because they're employed. And so I think these stimulus dollars can be spent much more precise. And I think the last case was a good one in that it went unemployment to the unemployment, some supplement there, the $600 under $75,000. Those are good items, and future stimulus ought to be likewise geared, because otherwise it gets diminishing returns. And then you have the issue of how you pay for it long term, and the issue of whether it creates inflation. But there's a lot of pent-up savings, and we would expect a good second half of the year.
That was part of my interview with Bank of America CEO and Chairman Brian Moynihan. One of the other things I talked about with Brian is the competition from major Chinese banks. And then he pointed out that they rival the biggest U.S. banks in their size already. Our colleague Hsbc Amin sat down earlier today with Hong Kong's chief executive Carrie Lam, who expressed concern about foreign banks doing business in Hong Kong and what she called foreign governments putting them in a difficult position.
There are no conflicting rules. I think the financial institutions have found it difficult because of arbitrary decisions made by the foreign governments, especially the U.S. administration. Just a month ago, they were under serious worry and threat about this sanction of individual officers. And if they continue to provide those sanctioned individuals with banking services, then they will be penalized. And just a couple of days ago, the the head of the HSBC, has been grilled in the UK Parliament for complying with a piece of legislation and actions taken by the enforcement authorities in Hong Kong. So Hong Kong is very proud of our rule of law, so everything is done in accordance with the law. Whereas what we have seen in other jurisdictions are pretty arbitrary decisions, very much driven by a political agenda. So one would ask which type of financial center one would like to be in. That is very clear rules, level playing field, and law-abiding bodies and government, or something which is very politically driven.
Let's pick up on HSBC. Questions now being asked if HSBC should split off its China operations. What are your expectations of HSBC, which is pretty much a bank with really deep roots in Hong Kong?
Yes, HSBC is very strong in Hong Kong and has been a very important part of our financial industry. It is a banknote issuing company and has taken a very wide interest in Hong Kong, especially as we now go into the Greater Bay Area. Okay, so of course I would love to see a stronger presence of the bank in Hong Kong, and I have been communicating with HSBC senior officials from time to time. And of course, I respect their decision. They are an international bank, but I tell them very categorically that there are huge prospects for the growth of the financial sector, the banking sector in this part of the world.
Do you see China taking action against banks in Hong Kong that comply with US sanctions?
No indication whatsoever, because as long as the banks are doing their job and as long as they are being fair, I don't see why the Central People's Government would take that sort of action.
Hong Kong Chief Executive Carrie Lam. Coming up, Jeff Blau, CEO of related companies, on bringing New Yorkers back to the office and the future of the commercial real estate business post-pandemic. This is Balance of Power on Bloomberg Television and Radio. You don't have to spend much time on the streets of Manhattan these days to realize it's a shadow of its former self. So we talked with the head of the largest landlord in New York City, Jeff Blau of related companies, about what it will take to bring New Yorkers back to the office. And it turns out that city government is one key factor.
So much is actually getting done. So you just see that someone wasn't doing their job the day before. Forget about ideology or you liked them or you didn't like them. Things weren't getting done. I mean, so you look at it today, I mean, every day we see a new executive order, a new bill, a new assignment. And I think it's been a refreshing movement in Washington. I think that the team that's been hired is very talented, and we're all optimistic about the future of Washington. But I think what's very important right now is that from a civic engagement perspective, everyone was so focused on the national politics. We need to really focus on our state and local elections. Here in New York, we have an upcoming mayoral race, and I think there's never been a more important race on a local level. If you look at New York and San Francisco, politics it's been a difficult leadership environment in both of these cities, and I think both of these cities have suffered because of that. The unfortunate thing here in New York is we have a voting system that only allows, essentially the next mayor will be elected in the Democratic primary as opposed to the general election. 70% of New Yorkers are registered Democrats. So not many people know that, and not many people come out and vote in the Democratic primary. So that primary is June 22nd as opposed to the general, which is in November. But what people don't know, in order to vote in the Democratic primary in June, you have to be a registered Democrat by February 14th. That's only 3 weeks from now. And there's no real mention of that. As a result, in our last election, only 3% of New Yorkers voted for our current mayor, put him in office for 8 years. 3% of New Yorkers. So we have really gone out and on a campaign to register as many Democrats, not because of ideology. You can register back the next day, but because we want everyone to have a say in the election. We want everyone to vote and have their vote count. So we're trying to get that message out, and I've personally been spending a lot of time on that and really pushing a get out the vote initiative. And I think the majority of New Yorkers want a more moderate leader, but the majority of New Yorkers are not voting. And so you often get these extreme views in our electorate.
You were very careful to say not for ideological reasons. Has the attitude of business leaders shifted in light of what happened, frankly, down at the Capitol just before the inauguration? We saw some businesses who had contributed to some of the people who had, for example, resisted the Electoral College tally. Some companies now are really pulling back from that, saying we better stay out of this, at least for the time being. Do you think there's been a shift in the attitude of business leaders toward making political contributions?
Well, there certainly has, factually. Look, the reason I say that is because I think that you can make a pure statement when you're asking people to get out and vote. I think that's a civic responsibility. I think it's civic engagement. And my personal view is that the majority of New Yorkers are centrist and moderate. And so the more people we get to vote, maybe we'll get the outcome that reflects the majority. So I think if you start imposing personal viewpoints on ideology or parties, then you're tainting the get out the vote initiative. And so I've been very careful really just to focus on get out the vote.
That was part of my interview with Jeff Blau, Related Companies CEO. Coming up, Balance of Power continues on Bloomberg Radio. In our second hour, we're going to talk to one of the Obamacare architects. He's Professor John Gruber of MIT. And this is Bloomberg.